budget numbers are looking to me and my team very rational, reasonable, and because of that, it adds a lot of credibility to India's budget number. So from budget perspective, a lot of channels ask, what is your score? And I rate it as a very, very good budget, getting almost 7.5 to 8 kind of a score. And today, we will start with my head of research, Amish. We will go across with each analyst with their view on the sector and their topics. And of course, our most well-known and cherished and chased technical and derivative analysts also will add their view on the stocks and sector that they like. And of course, I'll be back with the concluding remarks. So over to Amish to take us through the budget and his broader view on the markets.
Okay. Hi, everyone. So this budget, if you ask me, has something for everyone. First and foremost, it is targeting inclusive growth, because if India has to develop, it is not only the metros, the people who are living in rural India, the people who are, you can say, living in the interiors, tribals, so they have to come up. And there have been very specific schemes in this budget targeting the absolute bottom end of the pyramid, which will boost their standard of living, the income level, the infrastructure there, and which will provide a much more longer lasting growth. The second is that if you look at, say, the budget numbers, last year the government did very well. We had around 1.6 lakhs crore higher tax collections, out of which 1.2 lakhs crores was given in subsidies, which were very relevant subsidies for fertilizer and food, which again target the absolute bottom end of the pyramid in India. In the current year, the additional revenues which they are targeting, a lot of it is going to go in the additional capital expenditure, in railways, in roads, in other infrastructure, which will create employment. And when you create infrastructure, it has got much bigger ripple effects in the economy, because you create employment, you create demand for goods. And when people get money, they come out and spend. In addition to it, if you look at middle class, I think at least they will have something to cheer about this year, because there have been certain exemptions in taxation given, although it's in the new regime. So practically, if you look at in a very broader sense, the budget caters to the aspirations of everyone, be it middle class, be it salaried, or be it, you can say, the business class or working population. So our view on the market remains very constructive. In the near term, markets have been volatile due to one event or the other. But having said that, India remains today perhaps the best placed country globally in terms of growth, in terms of visibility, and where we are currently. So we remain optimistic on the markets. Our current targets are Nifty are 20,800, which we will revise maybe say in another couple of years, or as we go along, when the more clarity on the numbers and the results come. But we would advise buying on the dips, looking at the volatility in the markets. Now, coming to specifically the sector which I look at, which is the consumption space, I think the consumption space will get a boost in this budget, be it due to the, you can say, some little bit of tax relief, be it due to some of the reasons I illustrated earlier regarding the, you can say, the spending which the government is going to do in rural, towards the bottom end of the pyramid, providing free, you can say, food grains to people. So that will go a long way in boosting their disposable income. So particularly looking at the budget, because the increase in the duties on cigarettes has been very nominal, I think ITC looks good. The stock is currently trading at sub 20 times FY25. So the valuations are favorable. Next year, profit growth may vary between say 7 to 10%. But looking at the valuations, good dividend yield of say around 3%. I think around 350 odd rupees, the stock looks interesting, and it is a potential candidate to raise towards 380 to 400 rupees in within the course of 6 to 12 months. In addition to it, purely looking at budget, one can look at other staple companies like Liver and Dabur, because these two companies will also be beneficiary of any uptick in the rural demand. And if someone is looking to bet pure on the discretionary consumption, although there is nothing specific in the budget with regards to a discretionary consumption, then one can look at stocks like, for example, Titan Industries is there. Then you are having the quick service restaurant companies like Westlife Development is there. And maybe one can even look at Avenue Supermarket on declines. So now I will hand over to Himanshu, who is our auto analyst.
Hi, good evening. In this budget, we have seen the government continuing with its focus on the electric vehicles. So we have seen the PLI scheme getting more allocations, and also the FAME subsidy getting more outlay. Over the last year, we have seen that electric vehicles have crossed 1 million milestone and grown significantly YOY. And we see this budget helping electric vehicle penetration continuing to increase. We have seen the EV penetration in two-wheelers reaching around 5%, which is a good level, and should from here get a good trigger from this budget as well. On the commercial vehicle space, we think this budget is going to help it further. There is further outlay on capex, and I think the commercial vehicle space is going to get benefit from there. Overall, we have a positive attitude, positive view on the auto industry, and our topic is Maruti Suzuki. We see the earnings growing by close to 25 to 30% over the next 2 years, and our stock should move towards 10,600, which is our target price from current levels. So I hand over to our banking analyst.
Hi, good evening. This is Gaurav Jani. I look at banks, HFCs or AMCs. Pertaining to the budget, so frankly, nothing major for the banking space. Just two sort of things, if I may want to highlight. One was the agri credit number, or the outlay number was increased from 18 lakh crore to 20 lakh crore. So that was actually business as usual. Every year that increase happens, and just suggests that the government's focus to sort of on the agri segment. That's one. And the affordable housing outlay has also increased under the PMAY scheme from by about 66%, from about 48,000 crore to about 79,000 crore. So that increase is also actually in line with what we had seen last year, also suggesting government's increased focus on affordable housing. Coming to the stocks that we like, obviously the environment is a bit more volatile, so we would prefer to stick to quality. Among the large private banks, we would prefer ICICI Bank. Two reasons. One is a very strong deposit franchise in terms of maturity buckets. Deposit maturity is very favorable for ICICI Bank, and strong margin profile. So we expect about 12% earnings CAGR. Right now, the stock is at 2.3x on price to core adjusted book value, and we are assigning a 3x multiple to iBank. Among mid-cap banks, we prefer Federal. The share of high-yielding portfolio could sort of move up from about 5 to 6% to about 10-11%, which would cushion margins, and we are looking at an earnings CAGR of about 16% from 23 to 25. Currently, the stock is at 1.2x. We could look at valuations of 1.5, 1.6x, considering the quality of earnings that Federal Bank is delivering. Lastly, among housing finance, we like Canfin because of its focus on affordable housing and pristine asset quality with a stable compounding sort of growth. Canfin is right now at about 1.7x. I think we should look at a multiple of about 2.1 to 2.2. So yeah, that's about it. Thank you so much. I introduce Mr. Nitesh, who looks at specialty chemicals. Thanks.
Good evening. So I'm Nitesh Dood. I look at the specialty chemicals space at Prabhudas Leela. So while there wasn't much of announcements for the chemical space in the budget, slight disappointment because we were expecting the PLI scheme for chemicals to come through. So that hasn't happened. Largely, the announcement centered around the reduction in basic customs duty for some products, including acid grade horsepower, which benefits fluorochem companies like SRF, Navin Fluorine, GFL. A reduction in basic customs duty on ethyl alcohol, which benefits companies like Jubilant Ingravia, Lakshmi Organics, and GNFC to some extent. Apart from that, I think nothing major. And the benefits here depend on how much of the pass through happens because these are intermediate chemicals. So depending on how much pass through happens, certainly it improves the competency of these products both at a domestic level as well as at the international level. Our top picks in this space, include Jubilant Ingravia, where we have almost 80% upside on the stock, where we expect 25% CAGR for the specialty chemicals vertical, given the kind of investments going towards the specialty chemicals division. Large part of their capex allocation, almost around 70-75% of the total allocation of the company towards specialty chemicals vertical. That drives 25 to 27% earnings CAGR, for the company, in this specialty chemical segment. So that is one of our topics. The other one would be SRF, whereby we believe that the company has delivered very strongly over the years and likely to deliver strong earnings CAGR over the next few years, years as well, given the capex intensity which continues over there. So they've announced almost 15,000 crores of capex over the next 4 to 5 years, and 25% earnings CAGR expected for the specialty chemicals vertical there. So we are positive on these names, and that's about it from my side. Thank you. I hand it over to Amit Anwani, our cap goods analyst. Thank you.
Hi everyone, I am Amit Anwani. I look after capital goods. So with respect to overall budget, obviously it was a pretty positive capital goods sector, considering the very calibrated approach by the government in focusing very specific capex. So with regards to railway, we saw overall capex grew by about 15%, including internal resources and budget. And when I see and break down within the railway capex, it has focused a lot on rolling stock, where we saw Vande Bharat orders coming in, and the good allocation on PPP mode also. Plus good focus on railway line doubling, electrification. So we can see this, the beneficiary of this could be Siemens and the companies who are making rolling stock like BAML and to certain extent BHEL. And with respect to roads, we saw there has been a very good allocation on the road and highway sector. And when I break down X of NHAI, there has been a good growth on roads and bridges. And there could be companies, we saw special allocation to Northeast region for roads. So the companies like RVNL, Aircon, and this was for railway, for roads, PNC and KNR, all of these companies. And obviously we cannot forget L&T, which will be the overall beneficiary in this. Apart from this, there was very calibrated approach on the renewable side also. The government is deliberately focused on hydro and atomic energy, and we saw large orders coming into in atomic energy to few companies, including KSB Pumps and BHEL and MTAR. These are all beneficiaries on the nuclear side. And on renewable side also, through IREDA, government is focusing too much on solars, and that remains the key agenda. With respect to urban infra, there was a pretty decent increase in the metro allocation. We saw about more than 25-30% allocation for the metros, and obviously, as I mentioned, very calibrated with respect to where the government wants to focus with respect to the capex. And water also, we saw Jal Jeevan Mission again has saw 15-20% plus increase with respect to capex. So all beneficiary to capital goods companies, and in priority in order, L&T, Siemens, Thermex, and few of these companies will benefit in long run. With respect to topics today, we prefer APAR Industries, where we expect 25% top line growth and 35% CAGR growth on bottom line for 3 years starting FY22 to 25. And largely driven by pretty strong growth in exports, and this sector is also driven by capex in T&D sector, where we saw government announcing significant 13 gigawatt evacuation plan for renewable energy, and in export market they are also seeing tremendous traction in conductors and export. We have about 2260 target price, and stock has already moved, but we see a good potential in this time. Second is Triveni Turbine, where I'm seeing top line growing by about 27% CAGR, and bottom line again by 35% CAGR over a three-year basis. And here also, this company is primarily into the industrial gas turbines, and we are seeing good traction in waste recovery and private capex kicking in. And again, this company has been pretty much beneficiary of the strong export growth which they are seeing, and product mix changing and favoring the bottom line. So we have about 25% upside, 340 target price on Triveni Turbine. So for now, I think these are the two topics. Yeah, so I invite Jinesh Joshi, mid-cap analyst.
Hi friends, my name is Jinesh. I cover mid-caps at PL. Basically, I look at 3 to 4 sectors. One is media, multiplexes, luggage, hotels are the few sectors, and education as well. As far as the highlights from the budget is concerned, with respect to education sector, the total outlay has been increased to about 1,12,000 crores. From about 98,800 crores. So the outlay has been increased. That is the key highlight. Also, there was one passing statement made in the budget with respect to NEP. What will happen is that the NCF announcement has already been made for K2 classes so far, and this will lead to a kind of a subsequent announcements for grades going ahead, and this will lead to a very strong growth for both the publishers, which is Navneet and Eschand, because it will lead to elimination of the second-hand book market. As far as the topics with respect to budget is concerned, I think one can look at Navneet. It is a publication company whereby we expect the top line to increase from about 1,600 crores to roughly 2,000 crores. And the benefit for NEP will also start sipping in from next financial year onwards. The stock trades at about 12 times. So that's on the education side. As far as the other sectors are concerned, there was nothing specific to highlight, but on topics, I think one can look at Safari and Chalet. As far as Safari is concerned, we are expecting a very strong bottom line CAGR. We expect an EPS of approximately 75 for FY25, and the stock is trading at about 25 times FY25 earnings. And the market share gain has been also very substantial over the last couple of years. The current market share stands at 23% odd, and we have seen that company gaining market share from the market leader. So that is one company which one should be looking at. And another company in the hospitality space is Chalet. I think we expect the bottom line to increase from about 120 odd crores to roughly 300 plus crores by FY25, and this substantial jump is on the back of operationalization of new assets, be it the 2 hotels in Pune and Hyderabad, or for that matter, the upcoming 1.4 million square feet of commercial real estate in Bangalore and Mumbai, so to say. So a very strong earnings CAGR, and the deleveraging story can begin from next year onwards. The current debt is approximately 2,300 crores odd. So yeah, these are the two names from the mid-cap side, and one name from the budget side, which is Navneet. Now I would like to introduce our next analyst, Abhishek, who looks at oil and gas. Thank you.
Hello, everyone. This is Abhishek Datta. I cover oil and gas. There in the budget, there was nothing significant except the fact that government has allocated around 30,000 crores as capital grant for the oil marketing companies. My understanding is that while the companies are also yet to they are yet to comment on the fine print, but my understanding is that this is more to do with the energy transition, green energy transition, which the government has spoken about, and will be invested for this amount will go for setting up this compressed biogas plants and other green initiatives, which government is very positive about. Other than that, there is nothing much. Like government has provided around 2,500 crores for the LPG subsidy. This is against 9,700 crores, which was the number for FY23. However, like we have seen in the second quarter of this financial year, government has stepped in and provided another 22,000 crores for the LPG losses. And so we don't expect any pain for the oil marketing companies. Net, it's a neutral budget for the oil sector. Among our top picks, we like the oil marketing companies, especially BPCL, given the fact that the steep marketing losses which they had seen for the first 9 months of this financial year is largely behind. And now they are making a blended marketing margins positive of around 1.5 rupees. And it has come down from levels of around 14 rupees, which it was they were losing in the first quarter of FY23. Also, refining margins continue to remain very strong. Given the fact that Russian oil products will be banned from imports to European Union from next month, I think the refining margins will continue to remain very healthy. So I prefer among the oil marketing companies, BPCL, HPCL in that picking order. Also, Reliance is something which looks attractive at current levels after sharp correction. Given the fact that they will continue to deliver robust oil to chemical business, as well as the dominant position in retail and telecom space will continue to show good results. So, and in my telecom coverage, I think I continue to remain constructive on Bharti, given the fact that it's a duopoly market, and we'll see more instances of tariff hikes going ahead also. Thank you. I will now introduce Praveen Sahai, who tracks the mid caps.
Yeah, hi, good evening, everyone. So I track consumer durable. So in the budget, there are a few things. One is a PLI increase allotment. So around from 70 billion, and now it's on a 58 billion rupees increased on overall PLI scheme. There is electrification projects schemes also increased budgetary allocations. So these things are ultimately going to benefit the consumer durable space, and largely the government is emphasizing on creating the manufacturing eco space. In that also, they had reduced the custom duty on a couple of components, like in the panel TV components, as well as in the mobile camera. They had reduced from in the mobile camera from 2.5% of custom duty to 0, and in the TV panel from 5% to 2.5%. So these are all going to benefit the contract manufacturers, I can say, and ultimately benefit the durable companies from here onwards. So on my pick is Havells on this. So why Havells? Because of the earning growth of around 17-18% in the next couple of years for the company. We are seeing it. And that coming from their three verticals. One is a cable, which is continuously going to give a very healthy growth with all these allocations of budgetary allocations. Second is their ECD, which where a laggard from the last couple of quarters is expected to give a good numbers in terms of a growth with the improvement in the demand sentiment. And the third is the what the management guiding regarding the minimizing of the losses related to the Lloyd. So all three things is ultimately going to play out the way forward. And currently it's trading at also on the lower side of valuation of around 38-39 times of FY24 earning. And we have a target of 1447, which will give around 21-22% of upside from here. So I'll stop over here. I'll hand over to our next analyst.
Hi everyone, I'm Akshay. I cover the NBFC and financial services. So in this budget, there have not been many announcements for this sector, but as my banking analyst also said that the two main announcements were 9,000 crore additional infusion in the CGT MSE scheme and PMAY allocation that was enhanced by 66% to 79,000 crores. Our top two picks in the space are Cholamandalam Investment Financial Corporation and Bajaj Finance. Recent correction in Bajaj Finance provides a good opportunity as they are developing an omni-channel where customer acquisition is very robust. And we also expect AUM CAGR growth of around 23%. At current price, stock trades at around 5.3 times FY24 price to adjusted book value, and we have a target price of 7835 for Bajaj Finance. Chola is our next topic, and that is also firing on all cylinders, and they showed an 8% QOQ sequential AUM growth. That was the best in the industry in this quarter. And they're also venturing into new businesses, the MSME and consumer loans that is firing in all cylinders. And the new businesses showed almost a 44% QOQ AUM growth, which is very credible. So we continue to like Cholamandalam, and we have a target price of 820 on the stock. So these are my top two picks. Now I hand it over to Himanshu, who tracks agri-chemicals.
Yeah, hi. So good evening, everyone. So I am tracking the agrochemicals and the fertilizer sector. So right, starting from the agrochemicals, this happens to be the center stage of any political discussion, right? Starting from the budget as well as into the any election propaganda. So nevertheless, this has again taken the center stage in this budget also. So now starting from the agri input side, when you see, so what we have seen is the major allocation into the budget, right? Starting from the food subsidy to the PM Kisan, etc. So those were like majorly in line with what we were expecting, a 10-15% sort of growth. While on the fertilizer subsidy, you see, so there has been a decline by somewhere around 20-22 odd percent as compared to the last year revised budget. So that was largely due to the decline into the raw material prices globally, and which in turn has actually led to some reduction into the fertilizer subsidy. So this was again in line with what we were expecting, and this should be like neutral to positive for the fertilizer industry. Now going forward, what we like from the current standpoint is number one, the fertilizer names like Coromandel and Chambal, which happens to be our top pick, and these are like the better names into the fertilizer industry, having a better balance sheet and better management. So those are likely to gain going forward. And secondly, why we are liking this sector from the current standpoint is there has been a very good subsidy disbursement from the government during the month of October, November, and December, during the third quarter, basically. So which again would result into release of the working capital, and that in turn would be reflected into the interest cost saving, and to that tune, there would be an EPS accretion also in these names. And secondly, what we understand is that the balance sheet is likely to improve for all the better names like Coromandel and Chambal as compared to the first half, where we have seen the balance sheet deteriorating. So that in turn would be like improving going forward in the March 23 numbers, basically. So we continue to like these two names, while on the agrochemical side, we prefer PI Industries, so which remains our top pick in the sector, and that is largely led by a better revenue as well as the margins visibility. So we expect somewhere around a 20-22% sort of revenue growth with a EBITDA growth of 25% and a PAT growth of 25% for this name. And this is likely to outperform the overall agrochemical pack going forward. So yeah, that is all about the agri input segment, basically. So now I hand over to Mr. Param, who happens to be our pharma analyst. Good evening, everyone. So generally, historically, budget has been a non-event for the pharma space, and this has been the case this time also. Not much, nothing announcement on the pharma side. So I will directly straight away jump to our topic. So I will segregate healthcare into one on the pharma side. Our topic in the large cap space is the Sun Pharma. We continue to remain positive on the specialty pharma, the ramp up story, which has been doing very well. So the investments, what they have done historically in the last few years, the benefit of that is starting getting visible in the last few quarters, and that trend will continue. The recent acquisition of the Consenta Pharma also provides more visibility on the specialty side beyond FY25. So overall, we see 15% EBITDA CAGR from 23-25 in Sun Pharma. At current market price, the valuations are also reasonably attractive at 21 times versus the historically 10-year average P of 26x. So that is our top pick with a target price of 1175. In the mid-cap pharma space, we like JB Chemical. It's a predominantly 45-50% of the 50-55% of the revenue comes from the domestic pharma, where the visibility continues to remain very strong. And with the recent change in the management, the new management has been very aggressive on the new growth, on the new inorganic opportunities on the growth prospects. The recent acquisitions, what they have done on the domestic side, has been very value accretive and has been ramping up pretty well. And also their CMO business, which is their 10-15% of their overall export business, also provides a very strong visibility. So overall, we see around 25% PAT CAGR from 23-25. Even the valuations are trading at 19x on 25x on FY25, which is a discount to some of the names like Torrent Pharma. So this is one of our preferred mid-cap pick in the pharma. On the hospital side, nothing much announcement on the budget side. The only announcement what relevant was they are trying to have 157 nursing colleges. So recently the industry has been facing a lot of attrition on the nursing side. So obviously that this will address this one of the concern. Overall, in the hospitals, we preferred Apollo as a in the large cap and the Max Healthcare in the mid cap. Apollo clearly it's a predominantly present in the entire value chain. They are into hospitals, diagnostic as well as into the pharmacy part of the business where the visibility is very strong. In terms of earnings CAGR, we see around 25% EBITDA CAGR for Apollo from 23-25. Even the valuations are very attractive. Currently trading at 17 times EV EBITDA on FY25. And the mid cap we prefer Max Healthcare. They are almost doubling their capacity in the next say 4 to 5 years. So benefit of that will start getting visible from 25 onwards. So in case of Max also, EBITDA growth from 25 onwards would be in upwards of 15 to 20%. And the more important, most of this capacity which is coming up in Max is brownfield expansion. So that will be EBITDA accretive from year one itself. So that remains our mid cap pick in the hospital side. I also cover the real estate. Nothing much announcement on the real estate also in the budget per se, though as my previous colleague announced that PMI has been basically increased from 48,000 crore to around 79,000 crore. So that will more benefit to the affordable, but more benefit to the ancillary businesses, not on the real estate side. So not much announcement on the real estate, but from a sector perspective, our topic in the space remains DLF. Clearly, the deleveraging story has been playing out for the company. They have significantly reduced the debt in the last 12 to 18 months. And they have very strong visibility on the new launches, even on the pre-sales, which is one of the key indicators to watch out. We see around 15% pre-sales growth in the next 2 years. With the recent correction in the stock price, the valuations are also attractive. It's almost trading at 25-30% discount to our 1 year forward. Yeah, thank you all. Yeah. I will hand it over to Vaishali, who looks after the technical side.
Hi, good evening all. So today we saw market didn't sustain at higher levels and we saw a good profit booking emerging post the budget. So in that regard, we feel that further downside cannot be ruled out. We are expecting Nifty to go towards 17,200 to 16,700 levels. And that would be a good buying opportunity zone. Similarly, Bank Nifty also, 40,000 is somehow held on, but a decisive break of that, we will see a further downward slide coming towards 38,000. But having said that, we still have a bunch of stocks which are in a positive trend and to be bought at every decline. So right now, sector specific, I like auto sector and IT sector, which we have been repeatedly recommending, and among which, of course, stocks with the favorable risk reward are Maruti, TVS Motors, Tata Motors, and Ashok Leyland. And stock specific in IT, I have always recommended to start with is Infosys and TCS, and followed by the other tier 2 stocks, right? Such as Persistent, Coforge, Tech Mahindra. These are the stocks, and I have already given a note on the same. Now, individual stocks I would talk about, because overall metal sector for the long-term perspective looks very good. So stock specific, I would emphasize more on Jindal Steel and Power, Tata Steel, and also Hindalco. So these are the stocks which have a very good upside potential, and the levels and the note for the same, the stocks that I'm recommending, I shall be circulating tomorrow, because right now it won't be possible for you all to jot it down. Now in mid cap also, there are a few stocks which I really like and I have been emphasizing are Tata Elxsi, GMM Pfaudler, and since tourism was the highlight, one of the highlights, I'm looking at hotel stocks. So Indian Hotel, EIH, Taj Hotels. So these are the stocks which I have been recommending on a continuous basis. Today also we saw Indian Hotel, in spite of all this choppiness, it surged high and it is likely to make a new high. So this sector will be considered for an upward move. So these are the views for now. Let's see how we progress from here on. Thank you. Now I shall hand it over to Shilpa.
Okay, good evening, everyone. I handle derivatives, so I'll talk about data points. Looking at the setup for Nifty and Bank Nifty, even for the next two series till April monthly, and we see that Nifty is at a very decisive range in between 17,000 on the downside and 18,000 on the upside. And Bank Nifty likewise at 39,000, we have an immediate support with the upside capped at 43,000. So nothing much to do in indices as from derivatives point of view, because we see that the downside is likely capped, and from here towards 18,000 Nifty will move, and Bank Nifty again towards 42,000 zones. So in that regards, my stock specific venture would be, I am very bullish on NTPC. NTPC with the stop loss of around 165, one can look for targets of 195 and above. Then I am looking at, if you look at the sector rotations happening from the past three series, if I compare, I see a very strong momentum in textiles and auto, IT and metals. So in that regards, I like Tata Steel. Today also have given a call on Tata Steel with a target of around 130 to 135 on immediate basis, with a stop loss of 108 and 107 likewise. So one can look at even in options, you may try 130 on 125 call options, which is trading at around 3 rupees, which we have already recommended. And apart from that, Reliance also, though it is sliding down and it is breaking crucial supports, but I believe that 2300 even an option chain is looking like a very strong support, and we might see a turnaround story from here and move towards 2550 to 2600. So one very high conviction and a very favorable risk reward is Reliance to look after that. And of course, Chambal Fertilizers. Chambal Fertilizers also from 290 odd zones, it has taken multiple supports and has seen it moving towards 330 to 340 zones. So it is again in a very favorable risk reward. One can look at targets likewise. So that's it from me. So I hand it over to Vikram.
Hello, everyone. So I'm Vikram Kasat over here. So what we have seen as of now, that we have seen lots of positives. So let's discuss some of the negatives from the fine print from the budget. So one is clearly insurance stocks. So income from insurance policies above 5 lakh is taxable. So Jeevan Sanchay Plus and such products can see significant slowdown. So here HDFC Life, one of the key losers over here, given the steep valuation, earnings downgrade and derating could be there. Then there is REITs and InvITs, which will be negative. So many retail and many like HNI's part on in the embassy REIT. So distributions partly as redemption of debt, which was tax-free, is now taxable. So I feel embassy REIT, which is 50% of their payout can be taxable, should be on a softer note. Then there is MLD, which is big thing, like short-term capital gain tax introduced on MLDs. Earlier was treated as LTCG at 10% on MLD. So some of the wealth companies like Anand Rathi and all, they can see a softer from here on. Then there is one big thing on the real estate space, which is like capital gains in excess of 10 crore can be used to avail exemption via property purchase. As of now, capital gains could be set off against house property of any value. Now that limit is 10 crore. So Oberoi, Loda, DLF, such luxury projects may see softer numbers from here on. So this could be negative points from the budget. And I would hand over to Meet now for the global markets. Thank you.
Hi, good afternoon, everyone. So in terms of the global markets, one of the key things to monitor today especially is going to be the Fed policy. And in terms of the policy, a 25 basis point hike is what is expected. Now, this will be the smallest hike in the last 10 months, which is when the Fed started increasing interest rates. And what we think is that going forward, even though Fed targets terminal rate at 5.1%, with today's hike, they will reach 4.75%. And with commodities coming off, with inflation coming off, this could possibly be the last rate hike. What we should monitor, one should monitor in terms of the commentary, is for how long this rate of 4.75% will sustain. While the market believes that the Fed will have to kind of reduce the rates going forward, some participants believe that as early as June, they'll have to start reducing rates because of the risk of recession in the US. However, the Fed maintains its stance and says that, to 2023 year end, they will not be reducing their rates. We've seen this pivot by Fed every now and then. And what we believe is that a slight dovish commentary from here on will lift the markets up globally, and especially led by the NASDAQ index, which is the IT index over there. And if that happens, we could see growth stocks, bounce back from here. So from an Indian context, IT as a sector could do well. And we could also see other new age companies, the likes of Nykaa, Zomato, Paytm, kind of rally from here. These beaten down names that have come off 70, 80% from their highs could do well. So commentary is key to watch out for today. And this next thing will be the inflation numbers, that we see going forward. Core inflation being the key part now, since commodities have come off. And we do believe that this possibly could be the last rate hike in the 10-month cycle. So I hand it over now to Siddharth Vora for his views.
Good evening, everybody. Happy to speak to you and share some important views from our quant and macro desk. So what we are seeing is this is a year of weak macros, tight liquidity, polarized valuations across the different developed and emerging markets, coupled with weakening trend in risk-on assets and extremely different style of investing regime. What we are seeing is that the world for the last 1.5 years has been in a value regime. And in a value regime, if you don't buy stocks, keeping valuations in mind, then even if you buy the other companies, the investment returns are going to suffer. So we are keenly tracking how this regime is evolving. Is there a likely shift back to growth or not? But as of now, no real signs of moving out of value and into growth. And even the risk reward from some of our sentiment indicators does not suggest that it's still become attractive. So around the 18,500 odd levels at Nifty, our risk reward started turning extremely unfavorable, which probably made us move out of risk assets, but we are waiting for signs for it to turn attractive. Given this backdrop, our current positioning in terms of a diversified asset allocation strategy is that we are underweight with a negative bias on domestic equities. We are highly overweight on precious metals such as gold. We are neutral in terms of our positioning to fixed income, and we are gradually starting to build our allocation to global emerging markets, which now look way more attractive given the growth and valuation profile and inflation profile and monetary profile as compared to India. So we are gradually building position outside India into global emerging markets as well. And this is the broad view in terms of the macro backdrop and the asset allocation positioning. And we strongly believe that this year, which is fraught with volatility and extremely mixed sentiment, only asset allocation and a diversified portfolio approach will help you navigate this peacefully. So that's it. I will hand it over to Ritika to give a view on the economic indicators.
Hi, everyone. I'll just give a perspective on growth versus valuations in India vis-a-vis other global markets. So I'll just give a perspective on GDP first. So India is projected to be one of the fastest growing country in the world. So I'll give you an example of for 2023, IMF is expecting India to grow at 6.06%, and it's just a tad bit lower than Vietnam, which is at 6.2%. So overall, the growth is going to be higher, especially with respect to other developed and emerging economies. But the valuations are a concern. For example, India is one of the most expensive markets post, I would say, S&P, US markets. So basically, India's P for 2023 is 20.4x, while for NASDAQ, it is 23x, and for S&P, it's 18.3x. So the valuations are a concern. Similarly, you can say that EPS growth is also lower for 2023. Nifty is projected to grow at EPS. For Nifty is projected to grow at 5.2%.
24 and 25.
And for 24, it is expected to grow at 15.7%. And for 2025, it is expected to grow at 15.4%. Where, however, the EPS growth for other emerging markets is much more than India. For example, Korea is expected to grow at 34.8%. And Taiwan is expected to grow at 15.4%. So all in all, what I wanted to say that these countries are trading at much cheaper valuations with respect to India. So India can be in a consolidation phase for some amount of time, even though the growth are higher. So we are kind of, as Siddharth said, that we are treading with caution, though we are optimistic from the growth side, but the valuations being high, we are treading with cautions and adding other emerging markets to our portfolio and kind of cautiously optimistic on Indian equities. Thank you. So I'll hand it back to Head of Research, Amish sir.
Okay, hi friends, we can take up any queries if you have. So some of you have given some queries on the chat, so I will address these. So there is first query, which is a view on RVNL and mid-cap companies, mid-cap IT companies. So you see, as far as your IT sector is concerned, I think there has been a lot of correction in the profitability this year. The margins have come off. That is one. Secondly, their P multiples have also come off significantly from the peaks, if you make say 12 months back. So from here on, I think maybe another 1 or 2 quarters maximum of pressure, and then the performance of IT companies will start improving. So one can selectively look at IT companies for accumulation, but definitely the view should be at least say for 6 to 12 months, if not more, and not say for the next quarter or so. So from the medium to longer term, IT companies have entered a zone that they are looking now reasonably attractive. As far as RVNL is concerned, I think all the railway companies, railway related stocks, they are likely to do well because of the increased emphasis on of the government on the capex. Last year also the government has increased the capex, and I think in the coming years also it is going to happen. And RVNL, IRCON, all these companies are into, you can say, EPC, with railways being a predominant part of that. So I think RVNL and all should do well as far as your fundamentals are concerned. But I think all these companies, they have moved up sharply over the past say 3 to 6 months. So the returns will be more measured going forward, but the outlook on these remains positive. The second question on the chat is that why have all bank stocks dropped drastically? See, there is no particular reason as far as banking stocks correction is concerned. The bank numbers have been good, the NPAs are under control, the credit growths have been good. However, maybe say in a quarter or two, we will see that their NIM expansion phase will be over. That is one. The second is, I think, the kind of volatility which is there in the market and the likely impact of, if any, contagion happens because of one large group being under trouble. So that is one of the reasons why the banking stock might be under pressure. And the third could be the kind of re-rating which banking stocks have seen in the past 3 to 6 months. However, I think if you look at, say, for the next 6 to 12 months, unless until something very exceptional kind of an event happens, the banking stock continue to look from here on. The next question on the chat is that what will be the implications of Adani fiasco going forward? I think we would look more from the viewpoint of the markets, that if there are, say, you can say some collateral, etc., then that is a different thing. But otherwise, some of these companies have good businesses. And as such, we don't have, you can say, any coverage, or we don't have any clear, you can say, valuation view on these stocks. But if there is, you can say, some, two or three companies, maybe say, you can say that, for example, your particularly Adani Ports, then cement companies, and even their FMCG company. So these 2-3 companies are good fundamentally and business wise, but we don't have a concrete view, because in these kinds of situations, the stocks can show a lot of volatility because of the reasons which are other than fundamentals. Then the next question on the chat is that today I bought Indus Bank future. So what I have to do specifically if I'm interested in banking sector? So I think future, I think, you see, the bank has been doing well. It has got a presence in, quite a good presence in, as far as your, for example, your CV financing and vehicle finance is concerned. Fundamentally, there is no problem as far as this is concerned, but regarding future, I think it's a very short-term trade. So very difficult to say what is going to happen in the next 15 days or a month, but our long-term call on the stock remains positive. Then maturity on insurance premium more than 5 lakhs will be taxable. On how much impact expected on insurance companies' top line. So I think for HDFC Life, the impact would be, I think, 10 to 12% of the business comes from such policies. So there could be some impact of that. So, however, I think today the correction has already come. So as far as your exact numbers are concerned, we are yet to figure that out, and we will convey to you as soon as we are able to figure out the exact impact. And the next question is, what about SBI considering the Adani Group crash? I think we have already answered that. What is the future outlook of SBI stock? The stock is falling continuously. So I think we have already answered that some of these stocks, after sharp re-rating, they are in a mode of correction, although the long-term outlook remains good. Then view on defense, EV, agri, sugar, and ethanol. So I think many of these are quite attractive. Particularly, you look at defense, you can say the stocks have done well. There's a lot of emphasis of government on local defense production. But having said that, the stocks have also got re-rated significantly over the past 6 months or so. So I think if you look at, say, next year or two, the stocks look good, because for many of these stocks, even now the P multiples are not as high as some of the other private sector companies. So on, you can say declines, you can look at those stocks. EV, you see, there is no direct play, you can say, which is there. In case of electric vehicle, there are some ancillary companies or some companies which are suppliers to that. But having said that, I think the EV space has a lot of hype, which is associated around that. So I think regarding your EV, one has to be very careful buying into these stocks, because as you might have seen in the global scenario also, that some of the associated or even the ancillary companies to the EV businesses, they have seen a lot of valuation correction. So buying even a company which is related to the EV segment at astronomical valuations can be troublesome. Then agri, sugar, and ethanol, I think the analyst has already given the view that he remains quite positive on that. Then the next question is, should one join old regime or new tax regime after changing in the personal income tax? You see, even earlier, the tax rates in the new regime were lower. The overall taxation was lower in the new regime, but people who were having home loans and who were interested more on the Section 80C benefits, so they were actually, you can say, they were more interested in continuing with the old regime. Now the government has added sweetener to the new regime by lowering the taxation over there. So I think it depends upon your income bracket in particular, where you are and what sort of, you can say, tax planning and other, you can say, stuff you want to do. But I think practically speaking, in the long term, new regime turns out to be better than the old regime. Then the next question is on your view on Bajaj Finserv. I think it's a good company, a much broader play than Bajaj Finance, because insurance is there, all other things are there, but definitely not a cheap stock. Then view on ITC, I think we already stated in our opening remarks that the risk in ITC from the increase in the excise duty is over, because the excise increase has been, the cess increase has been very, very nominal. So just 2 to 3% price increase required in cigarettes. So given the kind of valuation that it is trading at, this is one stock which now, unless and until there is some, you can say, something nasty which comes in GST, the stock has the potential to go to 375 or 400 in the coming 6 months or so. So I think these are, you can say, these were the main questions which were there.
Last one.
Which one?
Thank you.
Yeah, that's all, friends. Thank you all for attending this event, and for Vikram for arranging this call.
Thank you.
Thank you.